Issuing 30-year bonds to raise billions over 5 years to pay for Singapore's development needs. The Institute of Policy Studies says that it's one way that the government can get over the financial strain of COVID-19. That's with more social spending, but much less future tax revenue. But economists say that kicking such a huge debt down the road, it may not be the best idea. Lo Min Min with this report.
The National Cancer Centre comes with a $600 million price tag. To pay for it, the government used mostly tax revenue. That's part of its policy not to burden future generations with current spending. But researchers argue many investments such as infrastructure give long-term benefits, so later generations will have to pay as well.
The debt can actually be good if it's used to invest in productive investments that are actually going to drive up productivity, drive up GDP growth. Current expenditures on education, healthcare, and even development expenditures, they actually have both direct and indirect benefits to future generations.
They're suggesting that the government issues 30-year bonds over the next 5 years. That will raise $100 billion, which goes directly to such development needs. It will be paid off gradually until 2055, so as not to raise taxes in the short term. Currently, revenue from bonds are invested in sovereign wealth funds. Returns from these go into the country's reserves. Researchers say dipping into that piggy bank may not be enough because of the pandemic. The crisis needed $100 billion worth of support measures, and tax collection fell an estimated 10% last year. That's amid already falling yearly revenue and rising spending needs. But economists warn that it could be tempting to borrow and spend on many so-called recurring long-term needs. Debt could also be a problem when another crisis comes.
The strain on the fiscal position at that point in time would be even worse than what we have been through last year. Because of the fact that Singapore is effectively debt-free, because we have no external debt, that basically allows the government the flexibility and the conviction to draw upon the reserve as and when required.
Experts also say there are no guarantees growth will continue as usual. An aging population also means a shrinking tax base. Interest rates could also go up.
If that happens, then it can be detrimental because then debt servicing can be very expensive. And the only way you will have to do that is to either raise taxes or actually then push it more for future generations to pay for it.
Instead, economists say it's much better to rely on the current model, which restrains wanton spending, both now and down the road.